Hello to all traders, and welcome to this monthly NFP engagement. Today it is the Friday, the 5th of June, and we are expecting the data for the month of May, of course. As we all know, this is probably going to be a very, very interesting figures to receive for the month of May. The expectations, if I'm not mistaken, just top of my head, is about 8 million people to be deducted from the jobs markets pretty much. So it's going to be a very interesting event. Most likely it's going to be a very effective one as well. Might see prices moving on to 40, 50 pip range. And that might, of course, continue after the NFP, considering also that we have dollar weakening at the same time, or we might see reversals. But we're going to talk about these in a minute. Now, in the meantime, I want to start by just redirecting you on my social media first. If you want to connect with me on Twitter and also LinkedIn, I'm posting there on a daily basis, obviously. And it would be nice to have you following my channels. Posting videos and technical analysis and other blog posts, obviously, on a daily basis. And some information also might be very relevant to your trading. So I would encourage you to join me and also help me grow my following a bit. Before we go ahead, I need to read out to you the risk disclaimer. Foreign exchange trading and investment in derivatives can be highly speculative and may result in loss as well as profits. Foreign exchange and derivatives trading is not suitable for many members of the public, and only risk capital should be applied. This webinar is provided for information purposes only, and no information contained herein constitutes a solicitation for the purpose of the purchase or sale of any commodity, security, or investment, nor should it serve as the basis for any investment decision. Now, since we are done with this, I just want to go and show you the first slide. This is the expectations, actually what we have seen over the past month, as well as the expectations for this month, okay? So now that said, we can see here clearly that the NFP, the previous NFP came out at around negative 20 million, okay? The forecast for this month is at 8 million people being pretty much deducted from the jobs markets, okay? And now the situation with, I mean, if you also look at the previous results, right? We got 20.50. I think the forecast, as you can see here, was 22 million, right? I mean, this 1.5 million didn't seem to have made much of a difference in this environment. But if you consider this divergence of 1.5 million is a number that we've never actually seen many times before. Not never, we didn't see many times before in the past either. So now that said, the expectations are for 8 million. We are expecting an increase of the jobs markets, or just say a decrease in the deduction to 8 million in the payrolls numbers. Now, April's data, which was the release that we received in May, we missed the expectations by like the difference that we see here, 1.5 actually Ks, not 500. And the data now points to a less bad jobs report. So we've seen, of course, some of the people returning to work because we see these jobs, the weekly claimant numbers being reduced, okay, on a week-on-week basis. And that seems to suggest that the jobs are, some people actually returning to work. Now, economists anticipate another negative figure, of course. Jobs are still being lost. However, the fact that they are decreasing in a slower pace, it might prove to be positive for this month's NFP, okay? Now, on to the May's release, we actually see the worst numbers, the worst figures on record. And a better figure, of course, can be naturally expected, right? Now, the employment is at 131 million in the US, okay? And that is its lowest level since February 2011. So now, obviously, if we see another decline, we might fall to lower levels in employment, and we might get to levels that we've seen in the financial crisis. Now, both February and March, however, were also revised down last month. And that is not a good sign, because we could see another revision of the 20.50 here over, right? And that is not going to be a good sign. Now, here's what the analysts are expecting. Minus 8K here, okay? We have the unemployment rate expected to come higher at the 19.8. And that is, of course, going to be a very, very, very big number, right? Now, in February, the analysts had estimated an unemployment rate of 16%. Of course, it came out at 14.7, less than the expectations, but okay, we did beat expectations, but it's not really a good figure, is it? Now, the hourly earnings is what we should also pay attention to, because they are accelerating as we see. The previous month was upbeat by 430 basis points, which indicates an exploding inflation figure, okay, for the wages, but then expectations are too low at 1% over here. When it comes to the year-on-year basis, we had a boom at 14.8 year-on-year, and now beat the monthly estimate of 3.3 at 7.9. But with lower rates, it will be very interesting to see how fast the inflation is moving. And if we look now at the CPI inflation, okay, wage inflation, CPI inflation, decreased to 0.3. It missed the previous 1.5 figure, and also the estimate is at 0.4. The PCE, however, which is the Fed's preferred inflation measure, is at minus 0.5, and that was from a previous of minus 0.2 month on month, and 0.5 from on a year-on-year basis from 1.3, which is a very big decline. Now, with the NFP, there is always three things we can do, right? Now, before the NFP release itself, is to look at the economic indicators, the lagging ones and the leading ones, because those are the ones that actually give us a lot of information regarding how the market has been performing, right? I mean, there's no way you know what is really happening in the manufacturing sector and the non-manufacturing if you do not have a look at the data of the past month, right? So with information giving us even more insights, for example, at how business conditions in manufacturing services, for example, signal an increase or an increase in employment activity, the jobs cuts and the jobless claims, ADP as well, which, if I'm not mistaken, was positive, consumer confidence, and then the leading indicators, which are pretty much treasury yields and equities and the crude oil prices, right? There is always a relationship between all of them. And when we see any of the leading indicators actually moving in either direction, whether up or down, just before the NFP, that seems to be always a sign of, well, some more insights, let's just say. But just to give an example, when yields are up, the market sentiment is bullish, right? So if the yields are up, that is a good indication that expectations are going to be are actually better than expected, okay? Now, when we talk about crude oil prices, for example, when oil prices are up, the market's expectations are somewhat positive, as the boost in inflation rises the prospects for higher wages, right? And we do have higher wages anyway. Now, what I have done, actually, in the next line, I've put together a table looking at the pros and the cons for the economic indicators, right? So the best way to do that is just to go over on the economic calendar and just pick the data of last month and look at the ones, as we just said, the leading indicators and the lagging indicators. So the leading indicators are more important because we're talking about more shorter time, and they are moving depending on market's expectations, where the case with the lagging indicators like the ISM manufacturing, because the results are always delayed. I mean, the most fast, I would say, lagging indicator is the average jobless claims, because they come out on a regular basis, on a weekly basis. But anything else, it's like we're looking at a month back as well. So we always need to take that into consideration. Now with the ISM, we've seen here the pros are, non-manufacturing came out good, employment component came out good, employment component in manufacturing as well came out good. The challenger job cuts are good. You can see there's a numbers of factors here that are positive, right? Actually, if I had also marked these as blue, it would be easier to identify, but we have 1, 2, 3, 4, 5, 6, 7, 8 different components. 2 of those which belong to the leading indicators, that they are positive. And on the negative side, on the con side, let's just say, we have the ISM manufacturing, what is still in a technical recession. We have the consumer sentiment from the University of Michigan being also negative, and the CB consumer confidence negative. Negative means worse than expected, right? So these are the numbers that we need to look at, and this table simply shows us that the results actually might be better than expected, okay? This is how we can take an idea from at least a macroeconomic perspective just ahead of the NFP, right? With the leading indicators, of course, being the ones that have more weight onto our decision, let's just say. The other part, the third part, because we've got leading and lagging indicators, is the technical analysis. This is what we need to do before the NFP, right? We need to draw support and resistances, high activity levels, because those are the ones that they're, bulk holders actually are just waiting for prices to reach the levels and either trigger shorts or longs. And we're going to see how we can work those out very, very, very shortly. Now, before we go there, though, there's something else we need to discuss. What we're going to trade, right? Obviously, there is several pairs we can choose. But one of the good ways to look, maybe not even while we are seeing the results coming out, for example, not trading for the short term or for the 10 pips, even in the long term, we need to look at which pairs the divergence between the yields, right, from one country to the other. So as we speak, the 4 countries that they are over the zero barrier, have not turned negative yet, is Canada, Australia, New Zealand, and United States, right? So we can trade any of those, but obviously since the economic report is for the US, we are going to pick the US dollar, that's the United States, 0.25 interest rates against, well, the worst interest rates performing bank at the moment is Switzerland, so it's minus 0.75. So if you add the 25 on top on that, the divergence between the US bank, Fed, and the Switzerland is 1%, right? That is the biggest divergence. So that suggests that in case the NFP is good, the dollar is going to receive quite good flows against the Swiss franc, right? Now, when we're looking at the BAT report, what we need to look at is which of the banks has the least divergence with the US, right? Because we're looking for a stronger currency against the United States dollar. That, as I said just a couple of minutes ago, we have Canada, Australia, and New Zealand, right? Now then you can choose any of those, right? But then we need to look at some other components. And another component to decide which ones you want to pick is to look at the currency strength meter just ahead of the NFP, because as I said before, equities, the yields being a leading indicator, we also have currencies being a leading indicator as well, because they move according to market sentiment and according to market expectations. Now, with that said, we can choose Canadian, Australian, or Kiwi, and we're going to go now in the next slide onto the currency meter to see which one of those is the strongest just ahead of the NFP. And as always, the 2 pairs that you can always trade, right, is the euro dollar and the dollar yen, because they're the most liquid. So there's no question there if you're looking, of course, for short-term trades. But in the medium term, I will be looking at the interest rate differentials with more weight, right? Now, choosing the best pair. We are seeing the Kiwi actually currently being quite strong. The Canadian dollar, the Australian dollar, the pound, which is similarly to the dollar as well. So yen is weak, euro is weak, the Swiss franc is very weak. So this confirms, first of all, validates as well the pressure that we can see incurring onto the Swiss franc in case the dollar comes out positive after the NFP, right? So trading dollar yen, dollar Swiss franc is a very good option today. And in case it comes out worse than expected, then Kiwi is a very good option for the day, okay? We'll have similar rates with the US, so it will be the one most likely that is going to push the dollar down in case the NFP is worse than expected. But then again, with the NFP, we expect a lot of volumes to come in, a lot of liquidity coming in suddenly, right? And as you all know, there are also a lot of trades placed at the moment. There is some slippage there to take into consideration, the spread that is rising, and generally speaking, the risk of whip shows. So if you haven't traded before in this event, it's better if you just watch for a minute and then wait for the markets to settle and then make a more orthodox decision, let's just say, with less risk. If you are a bit more risk averse, then you can close your positions or hedge. It really depends on how your equity is looking, how your P&L is looking, right? But always when you open trades, think about risk management and just don't go and open one lot if you have $1,000 account. It doesn't make sense. Now, if again you still want to take the experience and practice, as I said before, just let the markets settle for at least like an hour or so. See whether we'll have dead cat bounce or any of the formations that you probably are aware of. To be honest, the dead cat bounce, everybody knows about that one, but we're going to analyze that anyway in a minute. And then before we go into the charts, the most important thing is, guys, do not forget that we want to analyze the data post the release, okay? The headline, okay, everybody trades the headline, but then it comes to wage growth and unemployment, okay? And most of the people also seem to miss the participation rate. If your participation rate is high or low, it does make actually a difference on the unemployment. So why ignore very, very critical data for our decision, So look at the post-effectual bias, and that depends on all three, and even actually on fourth, the participation rate, as we just said. The other thing is that obviously we're not really going to pay attention to 20 and 30K job differentials here, because the divergence, we can see that we missed 1.5 million last month. Now if we miss 500, if we miss 1 million or 2 million, I don't think it's going to make much difference. But in general, we need a big divergence between the forecast and the actual in order to consider having some momentum and some good ranges actually taking on the trades. So today, what I will do, because TradingView seems to be becoming a bit awkward at times, where volatility and liquidity is high, I'm gonna use our MT4. Okay, so what I will do, since we talk about euro dollar is always the case. Pound, I'm not sure I should be looking at the pound. Perhaps we can add the dollar yen over here. Aussie is a good option, but don't forget Kiwi is a better one. Now dollar Swiss franc, yes, of course, and dollar yen. What I want to do here actually is go on the perhaps we can look at the S&P, okay, over here. So things are simple, okay? This is how we'll do some simple technical analysis that can help us. It's all about support and resistance, nothing else, okay? So we can go down on the daily or the weekly. First thing to do is draw a line over here, right? 113.50, this is our top. We're currently 20 pips lower. If we want to draw a low as well, because, we have seen very excessive moves on the euro dollar. That's why I'm using the weekly. But the idea is just to draw support and resistance levels, right? On the 1 hour, these are looking good for me. Okay, we are currently going to draw that one as well. So we still got some 40 pips into the basket on the upside and another 40 on the downside. Right? This is for the euro dollar. It's as simple as that. As simple as that, guys. Nothing more to be done. Dollar yen. High activity over here. Okay, and on the downside, we can go One level can be that one. The other level can be the opening or even the close of Wednesday. If I'm not mistaken, that's Wednesday. The other high for the day, the intraday high, will go on the hourly chart. Then again, you see from 109.20 to 88 is some sort of 40 pips again. So why I want to do a partial profit around the 109, which is also a very good psychological level. And on the upside, I wouldn't really look at, I mean, I would just add a fixed 10 pips on this target, let's just say, okay, because multiple targets are always a good way to go. Let's just add that one on the euro dollar, okay, in case you want to have multiple targets with partial profits. Aussie against the dollar. Again, I will go on the weekly because, as you know, Aussie has been driven up like massively, you know. We had some very good sentiment here over the past few weeks. So again, we need to go on the weekly and check really what's happening. The other price, the other level can be right here on the weekly, and then we'll go down the daily, see what's happening, go down the 1 hour. That's what we're looking, okay? So still, we're a bit far from that. So we're gonna place the first level over here, and don't forget as well to place one at the top as well. So from 77, we're looking at 70 cents, which is again a psychological level. And this is simply how we can actually draw support resistances. On the weekly, Kiwi, as you can see, we just talked about it, is very, very, very strong, right? So on the upside, I'm looking at 65.65. On the downside, I'll be looking at the 64.65. And if we go down the daily, we can do some more. Well, if we are far from prices, usually, I mean, this range, I can be quite excessive for this price. So what we want to do is go down a relatively higher activity level that we are now, 61, the 62 actually is here. But again, we are on the daily, it's pretty far from 64, right? So what we're going to do, we're going to go down here, okay? And this is the previous open on Wednesday again, okay? So if you can see, on the upside, we are very far from prices, like 50 pips away. You might want to just have a take profit somewhere in between, okay? And that's it. And we can actually lower that down. On dollar Swiss franc, and we'll have 3 minutes left. It looks like we're gonna just get on there right on time. On the downside, we're on the daily. I'm looking at this level, the 95.50. Top, I'm looking 9600. Okay, and also the 96, of course, very, very high, very good level to look at because it's a psychological level. We've got the 95.83, and going down on the hourly chart, I'm pretty sure we can, well, we can also draw another level on the upside over here at the top, which is the 96.20. Okay, so we're all sorted on the dollar Swiss as well, and perhaps that one, and the S&P. Well, that's the easiest one, 31.45, and the bottom is the 31.25, and then we go down to 31.15, and on the top side, well, we can just actually go another 20 pips higher or so, and that's it. Okay, so let's just go quickly on the economic calendar and check what we're getting there. 1 second. Okay, so Friday, we've got like a couple of minutes left. In the meantime, if there are any questions, feel free to ask, guys, right? So, for a couple of minutes, see them refreshing as we speak. Well, we can see them right here, non-farm payrolls, right? Unemployment rates. Usually we get different estimates, so I would actually ignore this, which is a huge number, right, for non-farm payrolls. The results I'm getting, the figures I got are the correct ones. So what we really need to pay attention to is first the headline number, how far are we from the forecast, and do not forget the forecast is 8 million, minus 8 million, right? We're not looking at this huge number. This is probably a typographic mistake, error coming from the economic calendar itself. So we start seeing prices moving a little bit, just tickling there. Oh, there we go. Well, this is a good report actually, right? All greens. All greens. Non-farm payrolls are 2.5 million, which is, 10.5 million better than the expectations. So the dollar against the Swiss franc is a good option, as we said before, right? 95.89 already taken. And, well, now we just have to wait and see how this is going to play out. Participation rate is at 60.80 versus a 54.2, also a very good number. But what I'm really looking at is that the headline can be traded on the upside, and then the unemployment rate and the average earnings also can be played on the upside, right? Which means we are going to see some good moves short term, medium term. Now for the long term, obviously, we do not know, because the long term is always, I mean, when we're talking long term for NFP, it's not like some years time, but short term, I mean, like right now, in the next few minutes, medium, it's considered to be like to the next 30 minutes, 1 hour. And the longer term, perhaps we're looking at next week as well, because this is going to have an effect, okay? So we can clearly see that dollar against the Swiss franc is leading, is going to take the 96 out already, and we're heading to the 9600, and this is a very good take profit level, and it's already done, okay? Now, euro dollar as well, if you were on the sell side here, 113 already taken. Guys, also need to pay attention to, I mean, when you're looking at the pairs, right, we need to look at each of those related to the other. For example, especially when we are near psychological levels, because when we get, for example, I'll give you an example. We got to the 70 cents on Aussie dollar, while at the same time, we got to 114 with euro dollar. We'll get to the 65 with Kiwi. And dollar against the Swiss franc, we'll get to the 96, right? So these numbers are not just coincided at the same time, the same period, randomly, right? It actually really shows the relationship between the currencies, right? That's why it's important when you're looking at the 113 on euro dollar, for example. You can look at the dollar yen being also on a psychological number. So, for example, where's our dollar yen? Dollar yen is, I mean, it's just the 109 instead, right? 113, 109, then Aussie, we're going down as well, but it doesn't move as much, okay, the Aussie dollar. I mean, the dollar yen did our move already. The S&P moved as well, exactly to a few pips above us we suggested. Dollar yen, the dollar yen is a bit of it's a bit far from its 110 psychological level. So the truth is that, we might not see that getting there soon. I mean, soon in the next few hours, perhaps. But one way or another, it's most likely going to get there, because this is a very good report, right? Now, at the same time, the unemployment, as I said, is what really is a very good indication. First of all, it's not just that we missed we beat the expectations, but we've also crossed below the previous month's figure, right? And the previous month's figure was the worst unemployment rate not seen for a while. I mean, I can't really remember the top of my head. Let's see here. But let's have a quick look. Yeah, we had a down revision here. Okay, 3.3. No, I'm not talking about unemployment here. I'm talking about the inflation. Anyway, the truth is that the unemployment rate was on a record low, or high, if you may, and this is not an indication that unemployment is increasing now, okay? It's an indication that it's actually getting better, despite the fact that it's still very far away from where it was, and this is expected. Now, at the beginning of this webinar, we did say that while the closely closely related data are shown, for example, the weekly jobless claims, they showed a slower pace, and that's why we're expecting that to bring the unemployment down at least, right? And this is what's happened actually. Now on the non-farm payrolls, here's the weird thing, right? There seems to be an increase, right? So we started getting people back at work, employing new people, and that's like 2 million people, 2.5 million people employed, right? I'll be honest, I'm not sure if we're going to see this number being revised next month, but it looks a bit off to me, considering the fact that not many people really have returned to work as the unemployment claims indicate, right? Now, what we really see again happening here is the S&P. That's why I wanted to have the S&P over here, because we see it moving it up. And well, at the same time, obviously the Dow is moving up, is up a bit, okay? And the question here, why I have the S&P, it's not just, you know, a matter of just having another pair over here. It's because the S&P is moving, I mean, it's retraced nearly 80% of its bottom, right? And many people now actually wonder, did we just, you know, experience a V-shaped recovery over here, which means that the equities will actually move higher and create fresh highs, or are we just going to go near the 3300s and then start moving lower, you know? The only thing that keeps equities high is money printing, right? Nothing else. I mean, we can't really take into consideration that the companies are doing well, right? Because none of them are doing well. I mean, there is some sectors that they are doing well indeed, but the ones that they weigh most on the jobs and on the markets, if you consider business confidence as well, is so low, then we really need to look at the S&P with a different eye, okay? And I'm just talking about something different now, about the fact that we're not done with coronavirus that just yet, right? There's still millions of cases worldwide, and if we just look at the US anyway, I don't think it's looking as optimistic or as good as the markets seem to suggest, okay? Now, we are seeing, and this is something that I talked about on the last slide, we're seeing the whip show effect, okay? The whip show effect is as I said to you before, we extend a pair for price discovery. The discovery here was on euro dollar, for example, at 113. At 113, we had a lot of blocks of trades coming in, long ones, right? And most likely what we're going to see now, price is going maybe a little bit higher. By the end, I mean, we're not very sure, but it could be by the end of the hour, moving up and then staying there and moving back down again at the into the next hour, or we could see prices by the end of the hour moving again back lower, okay? This is the whipsaw effect during the NFP or during any other event. It's also called, it's also known as a coil or recoil, which is something actually we have done. We talked about a strategy as well during volatile times on our exclusive webinars. And this is exactly what is happening right now. Now, the thing is, and that's why I've been saying, wait for the results first, and then you can assess, you can make a more orthodox, assessment. If prices end up at the end of hour above, okay, let's just take the dollar against the Swiss franc, right? If prices at the end of the hour come down and cross below the opening price, then that is going to be a bearish sign. And you can ask, but why would we have the dollar weakening if the report is good? Well, this is what institutional money does, right? It's just a bull trap, right? So we're gonna, this is what we see now as a bull trap. So we're gonna see prices reversing down and then perhaps moving up later. There is many scenarios obviously here, because as we currently look at the market, we are to consider the NFP results and only the NFP results, right? But then there is other factors that they could weigh on prices, right? I mean, which indicators are actually doing well? And then when we're talking about indicators doing well, it simply means for the Forex world that actually the data are better than expected. But data being better than expected means there is indeed an improvement, or perhaps in this period that we are, there is a slower pace of a deterioration, let's just say, because all the economic indicators all over the world are very, very, very bad. Okay? So that said, look at the NFP, but then don't forget that in the medium term, we're not supposed to be looking just the NFP. We'll look at other components, other indicators, and even geopolitics. As we all well know, the tensions between US and China have been increasing. They're going to increase. And, in the moment back in January, we had like a phase one deal and a trade war. Now we'll have a financial war, a tech war, and you name it. It's just going to be also unrolling in a period where, as if, we didn't have the coronavirus, then we also have to worry about the trade war. And then Australia getting involved as well in the trade war, China imposing tariffs. So you know the story, it's just like a domino. The question is which pairs are going to perform better, or which currencies are going to perform better against the other. In my opinion, I don't see many options. I mean, there's no currency pair that is going to be supported, because all of the currencies, all the economies are in a very bad state. But obviously, the fact that we always look at the currency pair against another, in relation to another, then obviously gives us some options here. And the truth is that with dollar yen moving up means weaker yen, excuse me, while the dollar is weak as well, which means that the yen is even weaker than the dollar. Well, we can actually probably bet on the dollar, on the Swiss franc being the safe haven of choice, at least in the short, medium term. But for this, we would also need to look at the gold, okay, and see how the gold is moving. And usually the gold moves along with the euro dollar, but I honestly don't want to talk about relationships, guys, because none of them are respected as we speak. I mean, you've got unemployment going high, wages going high. It's a bit of a nonsense case right now. So let's just go down. Where's the gold? There we go. So the gold is falling as well, which is expected, okay? And here's the thing now, okay? Dollar yen is moving up. Swiss franc is weakening. Yeah, gold is weakening, which is all natural. It's all fine. But they will look at other components. Dollar Swiss franc has been falling, and that makes a very good, very strong Swiss franc. Dollar yen has been moving up. So I'm not looking at yen for safe havens right now. And gold is moving lower quite massively, I would say. There seems to be some very good short bets here. some blocks of trades, I would say, at the 1700, let's say 1700 psychological level. We've been actually trading around that price since it's been a couple of days now, and now prices are moving lower, right? Now, let's just have a look at the gold, actually, because we didn't look at it at all. Well, that's already done. That could be an entry over here. And then we need to go down to, well, that's the 1675. That makes a good level, okay? On the weekly, if we look at the weekly, we bounced at this level, which is the close of like a few weeks back at 1680, right? Then with two candlesticks here, indecision candlesticks, and today being also Friday and also the end of the week, think about this. If we get this candlestick closing below the 1700s, it means that we'll have a very good engulfing pattern after two indecision weeks, right? And what would that suggest? Well, first of all, since we are penetrating the area of the, what is it? The 8th of the 30th, the March week over here, if we penetrate and close below that level, this makes this situation a little bit more bearish than, well, some of you might expect, to be honest. And when it comes to trading, and especially to the end of week, we're looking at end of week flows. And those end of week flows are very important, not just for trades on the Monday, let's say, but also for the medium term, because these over here could really mean that we're going to see perhaps a few weeks coming with prices moving lower. Now, if we break below the 1680, it means that we are actually penetrating more than just 1 week, right? And if we go below the 1672, then, well, it means that chances of getting even lower are higher, okay? So we need to look at the weekly candlesticks in order to make better decisions, right? And it doesn't really matter if you want to trade intraday, because at the end of the day, if a weekly candle closes down here, then the chances of prices moving up by the end of next week are not going to be as high. Are going to be slim, right? The lower it finishes actually this week, the more bearish it would look. Okay. Now, did we add? Okay, we did. So that's pretty much what's happening. As I said, I'm not really looking at dollar yen reaching the 110. And if we look at it from a long-term perspective as well, well, the next level we could get is over here, high activity, and it's the 109.80. Okay, I mean, we could continue moving higher after the NFP, but then I highly doubt we're going to get to the 110. Now, at the end of the hour, which is 13 minutes away, we're going to have more clues, okay? And I say that simply because where prices close is going to matter, okay? Let me just show you what we can expect, right? So I'll grab a pen over here. Second, so in case we close down here, I need to change the color one second. Same color as the, let's go for green. In case we, okay, we're moving up now. If we close on the hour here, right, and then prices move down, we're most likely going to bounce over here, 109.40 and move up. Right, most likely, because as we just said, we received a very good NFP report, right? Now, the other scenario is we're just randomly taking dollar yen, right? The other scenario is, I'll grab a different color here, just to make sure we can differentiate between the scenarios. In case we actually, by the end of the hour, come a little bit further down and close over here, right, then we are probably going to see more bets placed here, and that would increase the chances of prices getting to the opening of the hour over here, right? That's the 109.22. And from there, this is the level where we'll then decide whether we're going to move higher or lower, right? And then the other scenario, because we really need to be able to think about different scenarios, okay? And that depends on how the candlesticks are closing. The other scenario is that we are actually going to move higher without a pullback, and we're going to get to the 109.83 or so. That, however, would most likely come with a week, with actually with the candle closing without a wick, okay? Because wicks on the upside indicate, on the top, indicate there is pressure on the downside, right? I can't really actually, okay, there we go. This is a candle without a wick, okay? You can see it. And you see what happens. The prices continued higher, right? Let me just go back quickly here. Let's just erase that stuff. So look at this. This is a candlestick without over here, without a wick, right? Prices moved up. This is another candlestick over here. I mean, with a very, very small wick, right? Over here and over here. These are all indications of high momentum, right? So what's happening with high momentum? This is a high momentum candle as well. So with high momentum candle, what we usually get is if prices close with a wick, we most likely go into the 50% and then move higher. Or we'll go back to the high momentum entry, because this is where most of the money came in, the institutional money, and then we'll move up or we'll move down, most likely up in this case. Or we'll just continue without a wick, and we're gonna go up, take out the 109.82, then most likely we're gonna see doji over here after 2 or 3 hours and then start moving lower, okay? Now, since we've been talking about the dead cat bounce, and you're probably familiar with that, I'm just gonna go on a pair that is looking bearish, so that I can show you what the dead cat bounce would be. In this case, let's just have a look. Okay, gold actually makes a very good case, because it is a dead cat bounce, excuse me. So we're looking at this. Let's grab the red, the yellow. Hold on. Yeah. So we're looking at this, right? Bounce, bounce, bounce. It's called the dead cat bounce. We'll go down here. Now, what usually happens with prices, they come down there, it's the same as throwing a ball down. It will start losing pace, and slowly, slowly, this is going to happen, right? So this is called a dead cat bounce. Now, prices are moving higher, and that, I mean, if we close above the 1691, we could move a little bit higher and then move down. That would be the dead cat bounce over here, right? Now, there is other cases, of course, where prices take a little bit more time for that to happen. So in case we move all the way down and we'll close at the end of hour, which is in 8 minutes down here, that means we're going to see probably another candle breaking the 1680, then perhaps a doji, right? And the dead cat bounce will be a bit more more smooth, right? And will most likely move over here, coming next Monday, let's just say, bounce over the 1691 and then move lower, right? So when we're looking at the NFP, guys, we're not just looking about what to trade right now. We also get very insightful information just with this 1 hourly candle, right, about what is likely to happen over the medium term as well. So one scenario is this, yeah. Now I'll grab the pink over here. The other scenario is that we end over here, and if we end below that level, we could probably get a doji over here and move a little bit higher, or we can also reverse and go all the way up here. Usually is the 50%, right? So we're looking at this 61.8 perhaps over here, and then move lower. So we are looking at this hourly candlestick giving us what information? Information is this. We're going to get a slow retracement and a continuation down, or we're going to get a prompt rejection down the low, right? A rejection, a prompt pullback, and a continuation down. Now, the level I'm looking at to see whether prices are going to continue lower in the medium term or no, it's over here, because this is my high momentum candle. So the 1705 or whatever that is, if we cross above that level, so chances of prices moving higher would increase massively, right? With the next one being over here, because this is also a high momentum candle, the 1717, and last, the 1722 or so, again, a high momentum candlestick. So if you guys know how to identify those, which is very easily recognizable on the chart, to be honest, then the next one is here, and then we're looking at next top. Usually prices, in a very deep correction, we could come up here without reaching that level, right? And we would just end over here. There will be like a 98% retracement and then move lower. This is very, very, very possible to happen, okay? But obviously in this case, we're very far from that to happen, okay? It's very early to make assumptions like this. So then if we just go quickly, 1 second. I want to go on dollar Swiss franc, okay? Dollar Swiss franc has done very well. Euro dollar has done very well. Dollar again is actually doing well. Gold we just plugged in, so the S&P is moving high as we expected. Now, if you recall, we talked about the currency strength meter, right? When we talked about it, we identified two pairs. One that is very good for dollar strength and one that is very good for dollar weakness, right? And what we said for dollar strength, trade dollar against Swiss franc. Look at this. We went from 95.80 to 96.40. This is a 60 pip range, okay? And it's not normal to see 60 pips range in the dollar Swiss franc, especially on NFP. Usually it's around 40, 45. And then we also identified the pair that we want to trade against the dollar in case the report is weak. And that was because that currency would be strong against the dollar. And look at this one, that's the QE. The QE is the only pair that is actually the only currency that is holding very well against the dollar, right? And now we see we have 4 minutes left and prices on dollar against the Swiss franc are extending higher, which seems to suggest we're going probably to get to this high momentum at least, okay? So we're looking at 96.500 perhaps, okay, for a false break, either false break or a continuation to the downside, right? We need to actually wait and see whether this breaks for further clues, but take profit over here. It's already done, you see? It's already done. I mean, I didn't have time to tell you guys. So you can understand when you are just know a little bit about candlesticks, what you can do, right? So dollar, and we also talked, what was it, 15 minutes ago about the whip show effect, didn't we? We said the prices on euro dollar bounced at 113, then we got prices moving up 113.30, and then we said that's the whip show effect, so most likely at the end of the hour we're going to have prices moving back down again, and that's exactly what's happening, right? It's the recoil, if you may, it's the whip show, call it whatever you want, as long as you know how it works, it doesn't matter, yeah? So, yeah, if you're in on dollar Swiss, then, well, to be honest, it's up to you what you want to do, but in case you are, you pocketed some profits, I wouldn't want to push it more. Don't push your luck. If you do, make sure you put a stop loss way above your entry point, okay? So in case you're still in, just like close 80% of your trade, yeah? Move your stop loss up to the 96.20 and just let the rest play out. So you've already made 80% and you're just risking some of your profit, and that's it. So you're nice and safe. Now, coming Monday, of course, we do not know what to expect or how this is going to play out. But by the looks of it, it seems to me to be a case where, at least for the dollar Swiss, we might see prices. Actually, let me just go a little bit further out to have a better view. it seems to me a case where, if we go to the last one, that doesn't matter. Let's just take the second move. Okay, 1 second. From there to there. Okay, we could very easily get to the 61.8 Fibonacci. Okay, and that level is at 96.50, as I said, a very good psychological level as well, and at the same time, another high, the high reached on the 29th of May, okay? And we've seen a retracement over here. So we could get the same, we could get a rejection, but I would not go above that level today, okay? I wouldn't. So in case you're in, that's the best place. Here, most likely we're going to get prices. We might get a false break above here, but at some point we're going to get a very nice doji candle, or maybe we won't, but a retracement down to the 9600 is expected either way, okay? Either for a continuation, or it will just turn all negative, which will be most likely known once we break below the 95.80 level, okay? So guys, if you have any questions, since our time is up now, let me just quickly go on to, 1 second, let me erase that. If you have any questions, do not hesitate to just send me a message here, connect with me on Twitter and LinkedIn. If you have questions, I'll be happy to answer, okay? Now, in case you are in, as I said before, do not forget that it's Friday today. It's pointless to leave your trades open. We've also got weekend, expected gaps on Monday. So at the end of the day, if you still are with open trades, maybe look at the at where you can actually just take some profit and just call it a nice week and start afresh on Monday. So thank you very much for being with us for another month, okay, and for watching and trading the NFP live with us. And I will see you again on Monday. Do not forget, we have the Market Insights video. I will talk about the indices on Monday, the S&P, the Dow Jones, and the US index that seems to be weakening over time. Until then, have a nice weekend, and I will speak to you again soon.